very good evening to all the viewers of ET Now. This is the Money Show and I'm Karunya Rao. Let's kickstart the show then by looking at the top headlines of this hour. Okay, before we do that, here's what is lined up for the show today. First up, we'll be discussing SEBI's new mutual fund norms that will allow you and me to transact directly via exchanges. How can you benefit from this new development that has taken place? We'll be discussing that on the show. Also, we will look at NCDs, whether they are a lucrative option to invest in when compared to fixed deposit. Later, we will get you all the valuable lessons from Buffett's annual letter that you as an investor must look at with Rajesh Saluja. He's the CEO and MD of ASK Wealth Advisors. On our Spend with TMS segment today, we will dissect the booming trend of co-living and co-working. How profitable an option is it when compared to traditional leasing? We'll be discussing that on the show today. Okay, let's chat this about this big development that has taken place overnight, and a lot more about investing in the markets, multiplying your wealth. We have Neelabh Sanyal joining us right now on the show to talk about this and more. Neelabh, hi, thank you so much and welcome aboard. Very good evening to you too. So let's kick-start by first addressing the big development about SEBI allowing mutual funds to now being bought and sold over exchanges. How much does it help the Aam Aadmi?
See, it's on balance, it's a good development. Like Dhirendra already said, it adds, there are already various options available to mutual fund investors, whether it is the AMC websites themselves or even MFU, CAMS, Carvi, where investors can already go and place orders for mutual fund transactions. What remains to be seen is how will the exchanges themselves enable a customer-facing, sort of infrastructure, whereas, till now they have primarily been servicing business clients, which means their clients have been brokers, their clients have been market intermediaries who are enabling access. So in that sense, it's going to probably take some time, but we think on balance it's good because it increases more options, makes more options available to the investor, and anything that is sort of encouraging competition and probably lowering the cost of delivery at some point of time for the investor, it's definitely a good development.
While bypassing brokers and distributors can be a good idea from a consumer standpoint or a customer standpoint, but could it also mean that now they're on their own and they will have to do a lot of research on their own, and they will have to they may not have any external guidance?
See, we are Kuvera is an advisor, right? We are an online advisor.
Yeah.
And we still recommend the investor that any product or any investment that you make comes with a certain set of risks which are very unique to you as an investor. So you have to spend time to understand the product, you have to understand the ways and means by which you can take exposure to a product, what is the liquidity of the product, etc., etc. So that remains constant irrespective of what channel you're using to invest. Whether you're investing through a mutual fund platform, whether you're investing through an AMC website, or now once the exchanges enable that option, the amount KYC will not go away. Investors will still need to do KYC. They will still need to be involved in the process of transferring money for placing those orders or fulfilling those orders, etc., etc., and so on and so forth. So that level of diligence and that level of understanding is still required, and that will continue to be required.
Okay. So will it now see much heightened inflows, do you think?
I think we are, this development alone will not be the reason for heightened inflows. That
right.
There are other factors, tailwinds in the market, which will increase inflows, whether it is awareness, whether it is increasing education or increasing the need for other options to invest, because traditionally we are Indians like to invest in real estate and gold. Those options seem less attractive now, real estate being what it is right now. There is a need for flows to move into manageable products, manageable small ticket size investments, and mutual funds do provide that option. So the inflows will continue to increase. This is a positive development, but this cannot be the largest reason for it.
Right, okay. Neelabh, so let's move right on as well to our next topic that we would like to touch upon, and that is about NCDs in investment. We've seen in the recent past that the difference between the returns that one gets from a fixed deposit, an FD, and a low-rated NCD, which is a non-convertible debenture, has been the highest in a decade. So with the difference really widening, do you think NCDs are now proving to be a better investment bet?
Okay, so if you assume that all investors understand the product, only on the parameter of return, probably an NCD would give that higher, sort of alpha, or higher, probably a 1%, 2% extra over what they used to be traditionally offering. But we need to always understand this instrument and the nature of risks involved in investing in an NCD. For example, for first-time investors, it is probably a risky, sort of approach to put a large part of their savings into NCDs instead of fixed deposits. We would recommend exploring other debt investment options such as FDs. If you're salaried, then most likely you already have some exposure to debt through EPF. You can explore public provident fund. There are various mutual fund options that are available, which will give you a flavor of what debt investing is like, and it will give you exposure to diversified portfolios. NCD, you're taking concentration risk firstly. You're taking direct exposure on a company, on its business model, which as an individual investor, you may not fully understand or appreciate. That's one point. The second point is you're exposing yourself to three types of risk for most, which is applicable for most debt instruments. This is how you can sort of use thumb rules to evaluate what is the interest rate risk associated with it. So if interest rates move up and down, most investors will invest in NCDs, or like they would in FDs, hold them till maturity. So interest rate risk, you're not exposed to interest rate risk, but if the markets were to move on the positive side for you, you will not be able to benefit from that, because your interest rate is fixed, right? The other point is that it's not like the returns are guaranteed. In the case of an NCD, yes, you can select AAA rated instruments, but remember one thing, that over the last sort of 2 years, the kind of defaults that we have seen, most of those companies had issued AAA rated paper in any case.
Yeah.
So it's not like such kind of a event is unthinkable. And the most important thing is liquidity.
Right.
And for example, if you need money and your money is put in an FD and you need to withdraw, you can probably walk into your bank and the money will hit your account the next day. Of course, there are some charges associated with it, but it's possible. In an NCD, if you have to liquidate your position, you have to try, and you need to hold your NCDs in a demat form. You have to place the order on an exchange. There should be a buyer available at that point in time, or you may end up selling your NCD holdings at a significant discount because you need that emergency liquidity. So these are sort of the risks associated with it. First time investors can probably sort of wait it out a little bit for now, and once you get exposure, once you have a little better understanding of the product, then
But for those who are taking a calculated move towards investing in an NCD, what are some things to what are some basic checklists to watch?
See, of course, if you are taking direct exposure, so you're taking exposure onto a company, the rating is the first thing that you would look at. Ratings, there have been developments over the last, few months where the rating agency norms have been tightened. There is a lot of scrutiny around the ratings process. Some good will definitely come off that in terms of how rating agencies quantify risk and how rating agencies qualify their view on those businesses and the particular instrument that you're taking exposure to. So the credit rating of the instrument is probably the first thing that you should look at. You should ensure that you're not taking a very large of your part of your portfolio should not be exposed to one issuer. So you can spread your portfolio, probably not more than 10% into an NCD instrument from one issuer. So that is the sort of one or two things that you can that I could immediately suggest.
let's also discuss the environment. It's been quite tough for investors out there, especially in the aftermath of DHFL, Reliance Home Finance, these kind of companies, IL&FS crisis as well, where there have been very massive defaults on interest payment to their NCD lenders, which further, of course, weaken the sentiment and it just goes down spiral. It also pushed up the yields in a big way. So, what is your take, or what is your takeaways from instances like this? What is there to learn from these?
Right. I think the most important thing to learn is that don't make concentrated bets. When you invest in individual instruments or instruments that are issued by a single issuer, whether it is DHFL or IL&FS or whoever it may be, if there is something that goes wrong, your entire holding in that particular instrument is getting impacted. That is one thing to consider. The other learning is that, like I mentioned earlier, these were AAA rated instruments in the first place. There were, of course, sort of allegations of malpractices, etc., which sort of impacted their ability to repay their debt obligations or meet their debt obligations. But it could happen even in very genuine businesses, such as the development recently in the telecom sector, where some of the most prominent borrowers' ability to pay, because of the way the business cycle has evolved, the way the regulations have evolved, has been affected. Right, so mutual funds have had to take cuts, portfolio cuts. But the whole point is that if you had invested in a mutual fund, your exposure would probably be limited to 3 to 5% of your holding. But if you had directly invested in such paper, then your entire portfolio may get impacted.
Right. Let's also address some viewer queries. We have a live caller joining us as well. Mr. IP Singh from Ludhiana joins us on the phone line. Hi, Mr. Singh. Good evening, and thank you for calling us on the Money Show. What's your query?
Yes, ma'am. Good evening. Ma'am, my question is regarding debt instruments only. I would like to know, because since the news was coming, there is fall in the bond yields, government bond yields also. And as we were discussing about the NCDs and the FD instruments, regarding FD instruments, there are certain FD ratings that have been given to AAA negative. So is investing in those NBFCs, for example, LICHF or PNBHF, a better way, or investing in debt mutual funds like ultra short term or short term, those who are exposing their investments to NCDs or fixed debentures, that a better option?
Okay.
Considering this coronavirus, that is all leading to the tumbling in the market and the fall in the bond yields also.
That's a very valid question. Neelabh, would you like to take over?
Yeah, sure. So I would, sort of break down the assessment into two parts, or your approach into two parts. Firstly, if you are looking at purely the instruments that you mentioned, LICHF as an issuer, just that one issuer, I would recommend not to invest only in that one issuer. If you can spread your exposure to multiple issuers, that would be better. It would require that much more effort, but you have to consider that liquidity may be low, and if you can get past the liquidity constraint and being able to spread your investments across multiple issuers, then you can consider NCDs. On the other hand, fundamentally our advice is to look at debt mutual funds, because they offer you diversity in your portfolio. So your risk is minimized from one particular issuer getting impacted. That's one. And secondly, I would pay a premium for liquidity. If I need money and it is not available to me within 1 or 2 days, maybe some of my plans may get impacted. And or in case there's an emergency, I would like to have that liquidity. So if those things are important, then do consider debt mutual funds. Otherwise, look at NCDs. Coronavirus, like previous, and we've written about this, like previous such incidents, like previous such, sort of epidemic or issues of epidemic proportions, these are things which will come and go in the market. So it is temporary. Maybe in 3 months, 6 months, we'll be in a different position altogether. So I don't think you should make that as part of your decision matrix from a sort of 4-year, 5-year investment horizon.
There you have it, Mr. Singh. Both your questions are answered. Thank you so much once again for calling us on ET Now. Next up is an email query. Vishwanathan has written to us from Dubai. He asks, is there an NCD for NRIs with repatriation facility in terms of both principal and interest? Would you like to take it away?
Sure. So it is an interesting question. We did look up the regulation. It is permitted in the regulation, but normally most issuers shy away from opening sort of participation from non-residents because it requires significant compliance on the part of both the issuer as well as the investor. I would recommend, instead of trying to sort of look for NCDs and invest in those NCDs, do consider debt mutual funds, probably matching investment horizons. So short-term debt mutual funds can be in your portfolio rather than sort of NCDs, because NCDs will have these entry barriers. So you will be hard pressed to find NCDs which allow non-resident investors.
Okay, moving on then to our next email query. V. Rao has written to us. He says, I have an investment of 30 lakh rupees in IFCI subordinated bonds. I want to know where I can sell NCDs. Are there any corporate buyers for such NCDs? Neelabh.
So yes, there are buyers. The first thing that you can do is, if your holdings are in demat form, you can see, you can look up on your broker's platform or website. Is there any liquidity available for these NCDs? Unfortunately, it's not a straight cut answer because it's likely that this liquidity may not be available, which means that your broker probably, and you should approach your broker for this, they can help you find a buyer for your NCDs. At the same time, be prepared to offer a discount for liquidating your position on these NCDs.
Okay. And last and final query for the day, Siddharth Mishra has written to us. He says he has a lump sum of 15 lakhs to invest for his retired parents who are in their 70s, and both of them are pensioners. They don't need any income as such from this money, and they're looking for wealth creation and to diversify their investment. He wants to invest in debt funds and equity saving or balanced advantage funds. Could you suggest some funds which have a 5 to 10 years investment horizon?
Right. So this is a very well articulated query, and from the query it seems that it's since the needs are expenses, needs for medical expenses or living expenses are met through their current income sources, the investment horizon available can almost be thought of a wealth creation goal, or even this can be thought of something that can be the investor is thinking of creating an inheritance. So I would suggest sort of a diversified portfolio. The amount of risk that can be taken here is reasonably high because of the investment horizon. Consider, so we'll go in sequence, and I can give you some fund names that you could consider. So starting from the sort of liquid fund or the debt fund side, consider a Nippon India liquid fund. We recommend on the large cap side to consider index funds. This is a passive investing approach. It allows you to benefit from a lower cost of investing. So you can consider the DSP Nifty Equal 50 fund, consider the UTI Nifty Next 50 fund. Then for some international diversification, we would recommend ICICI Pru US Blue Chip Fund, and lastly for a focused fund, do consider the Motilal Focus 25 fund. So these are sort of the different funds. Notice I didn't mention what should be the allocation, because finally that is depending on your individual risk profile and your risk appetite. But broadly, the longer your investment horizon, the more risk that you can take, because time is on the investor side. And in this case, even a very important point is that even though the investor is retired, the life stage has a smaller role to play rather than the investment horizon. So the time that you have to invest can allow you to take significantly more risk than you would traditionally think. So that is the recommended basket, and you can choose the investment, you can choose the allocation across funds based on your preference.
Okay. We have time for one last query. A live phone caller is joining us right now. Gurmeet Singh from Amritsar. Hi Gurmeet, what's your query?
Hello ma'am. Ma'am, a question on safety on debt funds, ma'am. Even ma'am, AAA rated companies get defaulted, ma'am. So, ma'am, SEBI has introduced a category money market fund. Ma'am, are they safe or are they same as NCDs, ma'am?
Okay, we'll have Neelabh answer that for you. Please go ahead.
See, money market funds fundamentally invest in these kind of instruments, but investment grade instruments, of course. But they are not comparable to NCDs. If you think of money market funds, they are a basket of individual instruments. And in terms of the risks, and like we spoke about earlier, when you're investing in an NCD, you are taking your entire exposure is on that one issuer. So whether it is one company's NCD that you're buying or two companies' NCDs that you're buying, if anything goes wrong with one or the other, maybe even 100% of your investment in that instrument is at risk. In the case of money market funds or in the case of ultra short funds, or sort of these are, you're looking at the relatively lower risk debt mutual funds. More importantly, versus a single issuer instrument, which is an NCD, you are diversifying your risks across multiple instruments. So if one part of their portfolio or one part of a money market scheme's portfolio were to underperform or default or have to be written off, your exposure, I mean, depending on the exposure of the fund, you probably will have a 3 to 5% impact, which you can quickly tide over. So that is a way to think about diversification, concentration. Those are the key words to think about when comparing money market and NCDs.
Okay, Gurmeet, thank you for calling us, and Neelabh, many thanks for joining us in the
you.
studios and helping our viewers out and sharing your perspective on a host of developments that have taken place, and also on NCDs vis-a-vis FDs, which is a better investment bet. With that, we're slipping into a short break, but when we come back, we'll talk about why Warren Buffett says succession plan is important. He red flags the issuance of ESOPs and how to choose a company to invest in. We'll decode Buffett's annual letter on the other side of the break.